Good evening, this is Professor Mayer, and this is our eighth and final chat session. These sessions tend to go pretty fast. It's been a great semester. I always love teaching this class, so I thank you very much for your attention this evening. We are going to follow up on our discussion related to the statement of cash flow. What I thought we would do in this session, and these are the slides that I've given to you in our last session, is to go through some very specific problems related to the statement of cash flow. If you remember, the conceptual framework of the statement of cash flow is that we have three components. We have the operating activity. So the operating activity is where we are answering the question, did the organization generate a positive or negative cash from what it is that they do as their primary business? So the focal point of the operating activity is net income. The investing activity is cash inflow and cash outflow from investing, meaning the purchase and sale of assets, as well as investments available for sale securities, trading securities. For the most part, are going to flow through the investing activities, but the primary focus is going to be the purchase and sale of long-term assets to the organization. So one of the things that we talked about in our last discussion was the fact that if you had a gain on the sale of an asset, well, that gain is going to be removed, or that gain or loss is going to be removed from the operating activity. And the reason we're removing that is because the sale of the asset is in fact an investing item. One of the things that we talked about was the fact that the investing activity reflects the organization as it is purchasing long-term assets for future growth. Operating activity is the cash flow for the current period. So the hope is that the organization has sufficient operating cash to cover our investing activities and, in addition, any preferred stock dividends. So the difference between operating cash minus investing cash minus preferred stock dividends gives us something that many people would call or consider free cash flow. And this essentially is the cash that the organization has for dividends to the common stock shareholders. The last item in the statement of cash flow specifically relates to financing activity, and this is really related to long-term debt such as bonds, as well as the equity portion of the balance sheet. So if we issue a bond and we have cash coming in, that's going to be a cash inflow for financing. If we pay back the bond, that is going to be a cash outflow. If we issue stock, we're going to have a cash inflow. If we buy treasury stock, we're going to have a cash outflow. Again, all of this is from the financing activity. And then when we pay cash dividends, that's going to be a cash outflow, and it's going to be reflected in the financing activity. So those are the three elements: operating, investing, and financing. What we'll do is we'll go through a number of questions. We have more questions than we could possibly imagine to cover. So we have an hour. We'll go through the questions as we see them. So Springsteen Company has the following activities. I'm not going to repeat each of these because we're going to go through these one by one in terms of what they mean. But the idea is that what we want to consider is, are these operating? Are they operating where we're deducting from net income, or operating where we are adding to net income? Is it an investing activity? Is it financing? Or would it be considered a non-cash investing and financing activity? So what we're looking at is we're looking at the indirect method. So you notice it states that we're using the indirect method. Well, so what's the significance there? When we're using the indirect method, we are starting with net income, and then we are adding to net income and subtracting to net income so that we can get the final number from operating cash, which is cash flow from operations. So we're going to consider these items one by one and make sure that we understand what's taking place. So a pension expense that exceeds the amount funded. We'll just kind of think about this. So we have an expense, so this is clearly an operating activity, but the issue becomes is that in our pension expense is we have a cash outflow. So if the expense exceeds the outflow, it means that the expense is not as much as the outflow. So in this case, it's an operating activity, and we would add this to net income. The redemption of a bond payable, we just talked about that, is its financing activity. And if we are redeeming the bond, it is a financing activity where there is a cash outflow. The sale of a building at book value, a investing activity. If we sell it, we're collecting money. So the idea is that the investing activity, this would be a cash inflow. Now look at the next item, depreciation. Let's call this depreciation expense. So depreciation expense is an operating activity, and we're adding this to net income. Let's just kind of think about this and make sure that we understand what's taking place. Depreciation is an expense, but it is an expense with no cash outlay. Basically, depreciation expense is a debit, the credit is accumulated depreciation, and we are essentially allocating the cost associated with the long-term asset as it's being consumed within the organization to reflect the consumption of the asset within the operating activities. But you notice it's the depreciation of a long-term asset. Well, the long-term asset is part of the investing activity. So when we bought the asset, there is a cash outflow, but allocating the expense has no cash ramifications. However, it is an expense, so it lowers net income. So what we would do is we would add back the depreciation expense to net income to come up with our final number of our cash flow from operations. Exchange of equipment for furniture. You notice that there is no cash outlay in this case. It would be a significant non-cash investment and financing activity. Issuance of common stock, it would be a financing activity. The issuance of common stock would be a financing activity, and it would be a cash inflow. Amortization, same thing as depreciation. Amortization of intangible asset is the consumption of that asset, but the consumption of that asset is not a cash flow item, but it's an expense. So we would add back to net income the amortization expense associated with this intangible asset. Purchase of treasury stock is a financing activity, and it would be a cash outflow. The issuance of bond for land, you notice that the cash doesn't come into the organization, but there essentially is a transfer of a bonds payable for the land. Essentially what we're getting there is it is a non-cash investing and financing activity item. Payment of dividends, to make sure we understand it's a financing activity and it is a cash outflow, but only if it is a cash dividend. You get a CPA question and you say, oh, payment of dividends, it's cash outflow, financing, but you didn't read what it said. Maybe it said a payment of a stock dividend. Stock dividend is not a cash flow item. So when you see those questions, make sure you read the complete sentence as opposed to just sort of focusing on the word dividend. Increase of an interest receivable on a notes receivable. Interest receivable is an operating activity, and we are deducting it from net income. If you remember 2 weeks ago, what we said is that in the current asset items that are essentially reflected in the income statement or items, accounts receivable, interest receivable, all these items, as an adjustment, the adjustment is opposite the change in the receivable or the change in the current asset. So it's opposite. So the increase in interest receivable essentially means that we have interest income, but we haven't received it yet. The income is increased, but there's no cash outflow. Therefore, what we would do is we would deduct this from net income. Purchase of equipment is investing, and it is a cash outflow. So the following items must be considered in preparing the statement of cash flow using the indirect method for Granderson for the year December 31st, 2012. Plant assets having a cost of $25,000 6 years before were being depreciated straight line basis over 10 years with no estimated scrap value, were sold at the beginning of the year for $5,300. Let's just kind of think about this. There is an income statement item. It's either going to be a gain or a loss. We need to remove that. But at the same time, we are going to report a cash inflow from investing of $5,300. During the year, 10,000 shares of common stock with a stated value of $10 a share were issued at $33 a share. That's fairly easy. Essentially is we're looking at $33 a share times the 10,000 shares. That's a cash inflow from investing. You notice this. It says uncollectible accounts receivable in the amount of $27,000 are written off against the allowance for doubtful account. Okay, so it'll be interesting to see how they actually do that. Sustained a net loss of $50,000, depreciation amounted to $22,000, and a gain was realized on the sale for $39,000. Okay, so I think we actually will get the questions again when we go into the instructions, but let's just kind of look through this. So the first item is the plant asset had a cost of $25,000 6 years before and are being depreciated on a straight line basis over 10 years with no estimated scrap value. It was sold at the beginning of the year for $5,300. Plant asset, $25,000, accumulated depreciation, 25 divided by 10 times 6 is $15,000. So the book value at the time of sale was $10,000. Sales proceeds was $5,300. So what we would do, what we had is we reported a loss on sale of $4,700. Well, the loss reduces net income, but as we said, gains and losses from the sale of assets are removed. In this case, because it was a loss, we would add that back to net income to get cash flow from operating activities. And then the next piece of it was the fact that what we have is we have a cash inflow from investing based upon the sale of the asset. The next one is pretty easy. 10,000 shares at $33 a share is going to be a cash from financing, and it is a sale of stock, and essentially it is a cash inflow. The uncollectible doesn't affect cash flow. It doesn't affect cash flow because we're using the indirect method. The indirect method basically means that we are crediting accounts receivable and debiting the allowance for doubtful account. This doesn't have any effect on cash flow. The change in net accounts receivable is sometimes used to compute the adjustment to net income under the indirect method. But if we're using the net accounts receivable, if you're using the indirect method where you're looking at net accounts receivable, this would not really be an issue. This would not be an issue. So let's look at the next item, kind of a fun item. You got a couple of things in items here. So the company sustained a net loss for the year for $50,000. Depreciation amounted to $22,000, and a gain was realized on the sale of land for $39,000 cash. So we have several items here that we need to sort of embed in what's taking place. We had a net loss of $50,000, so that is our beginning item that you notice over here is the net loss of $50,000. The adjustments to this is you always add back the depreciation, so in this case it's $22,000, and then the gain would have increased net income, or in this case decreased the net loss, but because the gain on the sale is not an income or an operating cash flow item, is we take that out. So we reduce, it's a negative adjustment for the gain on the sale. On the investing activity, the sale of $39,000, not the gain, but the actual cash that we received from the sale, is added as a cash flow item from investing that increases cash. A 3-month U.S. Treasury bill was purchased for $100,000. The company used the cash and cash equivalent basis for its cash flow statement. So the purchase of the U.S. Treasury stock is not reported in the statement of cash flow. It's considered cash and cash equivalent. So essentially moving from cash to cash equivalent doesn't change anything. Patent amortization, $20,000. You would add back the amortization to operating cash, very similar to depreciation. Company exchanged common stock for 70% interest in Plumlee Company for $90,000. This is a non-cash item, and in this case, we'd report this as non-cash investing and financing activities, the purchase of the investment. So again, anytime the investment or the transaction bypasses cash that's going into the organization, it would be considered a non-cash item. During the year, treasury stock costing $47,000 was purchased. Treasury stock is a financing activity. You purchase treasury stock, this is a cash outflow item. So let's look at this. What we have is we have net income of $1,050,000. You notice a couple of things here. We have cost of goods sold, gross profit, operating expenses, and administrative expenses. So what we want to obviously go through is transfer this into the statement of cash flow. Accounts receivable decreased by $310,000 during the year. So what did we say? The current assets, the adjustment is opposite. So in this case, accounts receivable decreased. That means that it decreased because it received cash. Therefore, a decrease is going to be a positive adjustment. Prepaid expenses increased. That's going to be a negative adjustment. And then when we're looking at payables, the payables go the same direction. So accounts payable to the supplier decreases. Therefore, the adjustment is going to be negative. Accrued expense payable decrease. The adjustment is going to be negative. Administrative expenses includes depreciation of $60,000. That is going to increase. This is the indirect method. Indirect method, we start off with net income. First item we always do is we always add depreciation expense. So you notice the decrease in accounts receivable, just as I said, is the decrease in a current asset represents a positive adjustment when using the indirect method. Always think about current assets, the adjustment is opposite. Current liabilities, the adjustment is the same direction. This will save you 5 minutes in 1 or 2 questions in the CPA exam. Always remember that. I distinctly remembered when my professor told me this. When I got that question on the CPA exam, I looked at it. I didn't even have to think about the logic behind it, but I had embedded in my mind current assets opposite, current liabilities the same, and I was able to get the answer like that. And again, I saved a few minutes that I was able to use that time for another question. Current assets, opposite, so decrease accounts receivable, positive, 310. Decrease in inventory, positive, 300. Increase in prepaid expenses, negative, 170. Now the payables, the current liabilities. Decrease in accounts payable, negative. Decrease in accrued expenses, negative. Final adjustment, 105. Therefore, the net cash flow from operating activities is $1,155,000. Income statement that you see here, Rodriguez, sales, we have cost of goods sold, gross profit, we have net income of $1,050,000. Accounts receivable decreased, prepaid expenses increased, accounts payable decreased, accrued expenses decreased, administrative expenses decreased by $60,000. Not same thing, but now what we're doing is we're using the direct method. So in this case, the direct method, what we're looking for is we're looking for cash receipts from customers. So cash receipts from customers is sales plus the decrease in accounts receivable. So the cash receipts from customers is $7,210,000. Now you notice again that the decrease in accounts receivable increases the cash flow from cash receipts. Cash to suppliers is we start off with our cost of goods sold. We deduct the decrease in inventory. We have purchases. We add the decrease in accounts payable. Thus we have cash payments to suppliers. And then C is the operating expenses, is we have operating expenses of $1,090,000. We add the increase in prepaid expenses, decrease in accrued expenses, and we have the cash from operating activities is $1,380,000. Net income here of $90,000. Operating expenses excluding depreciation, $624,000. Depreciation expense, $60,000. Loss on the sale of the equipment, $26,000. Well, we know that that needs to be added back. Depreciation needs to be added back. And then we need to consider these operating expenses. Again, we have the net income of $90,000. Accounts receivable, you notice accounts receivable decreased. Accounts payable, you notice accounts payable increased from 2011 to 2012. Income tax payable decreased. That's a payable. So what we want to do is prepare the activity of cash flow using the direct method. So in this case, we have cash receipts from customers. So we have service revenue of $840,000. We add the decrease in accounts receivable. So we have cash receipts from customers, $862,000. On our operating expenses, we have $624,000. We deduct the increase in accounts payable. So cash payments for operating expenses is $609,000. And then our income tax is we add the decrease in accounts or in taxes payable. So we have cash payments for income tax of $44,500. Fairchild, so in this case what we're looking at is we're looking at our balance sheet from one year to the next. So you notice that our cash is increased by $700. So this actually is the number that we're going to match based upon defining the cash flow from operating, investing, and financing activities. So that's the final number that we need to come up with. A couple of things here that you will notice that the bonds payable actually decreased. We paid off some of the bond. The capital stock increased, so we issued some additional stock. We have accumulated depreciation. There's a change there of $30, so we're assuming that we had depreciation expense of $30. The plant assets increased by $200, so we know that there is a purchase of plant assets. Let's go through this and see what we can come up with. In this case, in Fairchild, we have sales of $6,900, net income of $810. During the year, $70 of common stock was issued in exchange for plant assets. No plant assets were sold in 2012. Cash dividends were $260. So we want to prepare a statement of cash flow using the indirect method. So let's just kind of think through this. So $70 of the common stock was issued in exchange for plant assets. Well, let's just kind of look through this. Is common stock increased by $200? So 70 of that is attributed to a non-cash item. Plant assets increased also by $200. 70 of that is, again, attributed to a non-cash transaction. We have net income, $810. Depreciation expense is the difference between accumulated depreciation from 2011 to 2012. So it actually increased by $30. So we add back the $30,000. The gain on the sale of the investment is going to be a reduction. And then we have a couple items there. We have decrease in inventory, increase in accounts payable, increase in accounts receivable, decrease in liabilities. And again, those current asset items flow through the same strategy that we had, a decrease in inventory, current asset item. The decrease in inventory is a positive adjustment. The increase in accounts payable, that's a current liability, is a positive adjustment. Increase in accounts receivable, current asset increase represents a negative adjustment. Accrued liability decrease is a negative adjustment. So net cash provided by operating activities is $960. We have the sale of held to mature the investments of $250. And then the plant assets is, if you remember, what we said is $70 of that plant assets was a non-cash transaction. The plant assets increased by $200, therefore $130 of that is a cash transaction. Investing, same thing with the capital stock. There is an increase in capital stock of $200, but we identified that 70 of that was a non-cash transaction. There was a retirement of the bonds payable and a payment of dividends. There is a net increase in cash of $700, which is reflective in the changes in cash. So let's go back to this and make sure that we see what the number is that should reconcile. So you notice that the cash increased by $700. So after we've done the complete transaction, we should see a net increase in cash of $700, and then we reconcile that by looking at the cash from January 1st, 2012 through December 31st, 2012. Let's look at this item here, and this actually is the same thing. I'm assuming that we are now going to look at this from the direct method. So in the direct method is we have the cash collected from customers, is we have net income minus the change in accounts receivable. We have cash paid for merchandise, cash paid for selling and administrative expenses. As you can, I don't want to bounce back and forth and actually look through those numbers, but you can actually see where those numbers are coming from. So we have net cash provided by operating activities. The investing activities, we have the sale of held to maturity investments that we've already seen. So you notice that the cash flow from investing and cash flow from financing are the same. The only time you're going to see a difference between direct and indirect method is as it relates to the operating activity. Investing and financing are always going to be the direct method, so those items haven't changed, but you notice that the numbers are still the numbers. We end up with a net increase in cash, which is reflective of the difference between the January 1st cash and the December 31st cash. What we're looking at here is Morgan Stern Company, and we're looking at December 31st, 2011 and 2012. So you notice that cash increased by $5,000. It went from $10,000 to $15,000. We have current assets other than cash, long-term investments. Long-term investments decreased by $43,000. Plant assets increased by, looks like $110,000. Accumulated depreciation, there's a change there of $20,000. Current liabilities, and so forth. Okay, so you can read those numbers. So let's see how these numbers are going to flow through. We have a couple of other items. Held to maturity carried at a cost, were sold for $34,000, so we have a loss there. The loss was incorrectly charged directly to retained earnings. Plant assets cost $60,000, were 80% depreciated, were sold during 2012 for $8,000. This loss was extraordinary. Net income, as reported on the income statement, was $59,000. Dividend paid was $10,000. Depreciation was $28,000. So we want to prepare a statement of cash flow using the indirect method. So we start off with net income. In this case, the net income is $46,000. The adjustments, we're adding our depreciation expense, adding our loss on the investment, our loss on the plant assets, the increase in current assets other than cash that we've identified, and the increase in current liability. Cash from investing, sell the asset, sell the held to maturity investments, and the purchase of the plant assets, $180,000. Financing is the issuance of the bond payable, payment of dividends, net cash provided by activity. Financing is $65,000. We have a net increase of cash of $5,000, and it is reflective in the change in cash from January 1st, 2012 to December 31st, 2012. You notice that the net income that we used in the calculation was $46,000. Why was this? We had this issue related to loss of, in this case, $9,000 was incorrectly charged directly to retained earnings. We need to reduce net income by that extraordinary loss, but again, we need to add back that extraordinary loss as an adjustment to the statement of cash flow. Here we have a balance sheet. We have cash, current assets other than cash, investments, plant assets, current liabilities. So current assets is $165. Liabilities and equity, same thing, $165. So our balance sheet is in balance. Let's see what else we have. A tract of land was purchased for $11,000. Bonds payable in the amount of $20,000 was retired at par. An additional $10,000 in common stock was issued at par. Dividends totaling $9,375 were paid. Net income was $30,250 after deducting depreciation of $13,500. Land was purchased through the issuance of bonds. So this would be a non-cash transaction. What we did is we sold part of its investments portfolio for $12,875. This transaction resulted in a gain to the company. The company classifies the investment as available for sale. Both current assets, other than cash, and current liabilities remain at the same amount. So we want to do the indirect method. This certainly looks like an indirect method here. So we have net income. So let's just make sure that we see net income. So you notice that net income was $30,250 after deducting $13,500. So we have $30,250 at net income, and then we add back the $13,500. There is a gain on the sale of investment that we are reducing net income. We have net cash provided by operating activities, $41,750. Investing activity, the purchase of the land, is a negative cash flow item. The sale of our investments is a positive activity. Payment of dividends, negative. Retirement of bond, negative. Issuance of stock, positive. So we end up with a net cash increase of $24,250. We basically then can prepare our new incomes or our new balance sheet, and our new balance sheet essentially is reflective of these items here. Again, I'm not going to go through each of these items, but you get sort of where we're going with this. And I think it's very important to understand the fact that if you have the income statement and the balance sheet and there's a few of these other items, you're going to be able to reconstruct the other items. So if you have two of the statements plus additional items, you should be able to reconstruct whatever statement is missing because they all tie together. There's no question about that. They tie together. So this actually is an interesting problem. I strongly recommend that you kind of go through this and understand where these problems are coming from. So we're looking here at the ledger of Popovich. So we have retained earnings. Retained earnings is the 1-1 balance, $42,000. There's a cash dividend, which is debited, so that's reducing it. And we have the net income of $50,000. So our retained earnings has an ending balance of $77,000. Machinery, we start off with a debit balance of $140,000. We purchase some equipment, so the equipment is increased by $62,000. We construct equipment for $48,000, and then we sell some machinery for $66,000. Accumulated depreciation, we have a credit balance of $84,000, an extraordinary repair of $21,000, accumulated depreciation sold $25,200, and the depreciation for 2012. From the postings in the accounts indicate how the information is reported on the statement of cash flow by preparing a partial statement of cash flow using the indirect method. The loss on the sale of the equipment was $5,800. So let's go through these numbers again. So we have retained earnings. So we know that dividends are going to decrease, or going to be a cash outflow from financing. Net income becomes the beginning point of the operating cash flow. We purchased machines, we constructed the machines, and we sold the machines. And then in the final item, we have an extraordinary repair. We have the sale of the equipment that we need to account for, and then our depreciation expense. So let's kind of go through what we know. We don't know everything, but we know a couple of things here. So we know that net income starts at $50,000. We know that our depreciation expense was $16,800, which is what we see over here. Our loss on the sale of the equipment was $5,800. So we have a net cash for operating activities, $72,600. Investing activities, we purchased equipment for $62,000. We sold machinery for $35,000. We have the extraordinary repair, the cost of machine constructed, $48,000. So we have net cash used by investing activity, $96,000. And then the payment of dividends is an investing activity. So there may be other items that are incorporated in here, but at least we know what we've got. So in this case, we're looking at the exact same thing, but what we want to do is we want to prepare the journal entries for all adjustments should be made on the worksheet for the statement of cash flow. So in this case, the worksheet entries is we're going from retained earnings to cash dividends. We're going from net income, retained earnings to net income, accumulated depreciation to depreciation expense. Machinery, we acquired a machine, we purchased a machine, and we have a machine construction that we actually constructed. Accumulated depreciation as well as the investing for the extraordinary repair. And then the final item is the loss on the sale of the item. So let's go through this final problem and then see where we are in regards to time. My guess is this probably will be the last problem that we're able to do. So the following is Sullivan Corporation comparative balance sheet for 2011 and 2012. So what you see here is that our final item is going to be cash. So cash increased by $115,000. We have a decrease in accounts receivable, a increase in inventory, property, plant, and equipment increased, so there was a purchase. Accumulated depreciation increased, so we're assuming there was a depreciation expense. The investments increased, and then on the accounts payable side, we see accounts payable increased, income tax payable decreased. Doesn't look like anything happened to common stock. Retained earnings essentially is going to flow through our income statement. December 31st, Sullivan acquired 25% of Myers for $275,000. On that date, the carrying value of Myers' assets and liabilities approximated their fair value was $1,100,000. Myers reported income of $140,000 for the year ending December 31st, 2012. No dividends were paid. on Myers common stock. Sullivan loaned $300,000 to TLC, an unrelated company. TLC made the first semi-annual principal payment of $50,000 plus interest of 10%. So we have financing activities there. We have an operating activity. On January 2nd, 2012, Sullivan sold equipment costing $60,000 with a carrying value of $38,000 for $40,000 in cash. So we have, in this case, the carrying value $38,000. We sold it for $40,000. So we have a gain. So that is going to affect the operating activity. We also going to have an effect on the investing activity. We entered into a lease. Present value of annual lease payments was $400,000, which equals the fair value of the building. Made the first rental payment of $60,000. Net income was $370,000. Net income was $370,000. Depreciation is based upon the adjustment or the change in accumulated depreciation, but we also need to take out the, we'll go through that calculation. The gain on the sale of the equipment, we've talked about that. The equity earnings is a negative adjustment, and decrease in accounts receivable, I think we've talked about that. Cash flow from investing, pretty straightforward. The dividend or the cash flow from financing activity, the dividends paid, keep in mind that the dividends paid, the amount that was actually paid during the year as opposed to actually just being declared. Okay, so depreciation, this is sort of the calculation that we need to go through, is there is a increase in accumulated depreciation of $125,000. However, we sold equipment and the cost minus carrying value means that we basically had an adjustment there for this item of $22,000. Therefore, the actual depreciation expense was $147,000. Gain on the sale of the equipment, we talked about this, was $2,000. The equity earnings was 25%, which is $35,000. Well, that's not our earnings, so we need to take that out. This is as far as we were going to go. I kind of anticipated this was going to be our last question. We zipped through a number of questions. I think we pretty much covered the things that we needed to cover. If you can come away with this to understand when it's an operating activity, when it's financing, when it's investing, you need to understand when you're looking at the gains and losses and understand that we need to extract those gains and losses from operating, but the actual sale of the equipment is the investing activity. The other item here that we need to understand is that if you're getting the depreciation expense from the change in accumulated depreciation, you also need to account for any retired equipment or sold equipment that the accumulated depreciation was taken out. You need to add that back to come into the depreciation expense for the year. So in any event, I think we've covered a lot of material. Everybody have a great evening. Thank you very much. I appreciate your time and attention. Okay, bye-bye.